Hey everyone, it's Hamish from the Young Investors Podcast. Myself and Brandon are excited to bring you your weekly rundown of the latest business and investing news from around the world. A quick reminder before we get started, any advice provided by Brandon is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you. Brandon Kolk is authorized to provide general financial product advice in Australia and is authorized representative number 1305795 of Guideway Financial Services Proprietary Limited, AFSL number 420367. Please see the description box for Brandon's financial services guide. Past performance is not a reliable indication of future investment returns. But with that said, let's get into another episode of the Young Investors Podcast.
All right, guys, welcome back. And today I have a very special guest who I haven't spoken to for quite a few years. I've been messaging him a bit on Instagram, but I haven't actually spoken to him face to face in a fair while. And he is the one, the only Daniel Pronk. You probably know him from YouTube. You've probably seen him before. How you going, man?
I'm doing great. How are you doing?
Yeah, I'm doing very well. Thanks for taking the time and thanks for joining us on the Young Investors Podcast. It's good to have you back on.
Yeah, it's been a minute, hey? I think it's been like 3 years now.
It's been a long time. What you been up to in that time? You got to catch us all up on the last 3 years. You've got 30 seconds.
Making content, getting engaged, living life.
Yeah, dude.
Wine, you know, the usual.
Yeah. You've been more busy than me, that's for sure. That's for sure. We're going to talk about all of that. So we're going to talk about a lot of investing stuff in this podcast. We're going to talk about maybe a little bit of YouTube, a little bit of business, a little bit of life if we get to it at the end. But for those that don't know, Daniel, I feel like we're very much on the same page. You, myself, Hamish as well. We're all kind of from that same investing school of thought. For those that don't know you, haven't watched your content, how do you describe your investing philosophies and your kind of investing approach to people that ask?
Yeah, I would say I try to emulate Warren Buffett, Peter Lynch, and Charlie Munger as much as I possibly can. So, you know, the buy and hold high quality businesses for the long term. Don't try and speculate too much. Don't chase hype. Really focus on the fundamentals of the business. And that's really what my investment strategy is. I've broken it down into 3 different things now, which you'll probably recognize if you've read, I think his name is Phil Town.
Yep.
So he
has rule 1 investing approach.
Yeah, but I actually think about it differently. So he has the 4 M's, which are moat, management, margin of safety. Then he has meaning. I don't focus so much on meaning in my own investing, but I do focus on the moat, management, and margin of safety. So the moat, I'm sure your audience knows, as the business's competitive advantage. What is actually going to allow it to succeed over the long term and continue growing? Then I focus on strong management teams. Typically, what that looks like is the insiders have a high stake in the business as well. So high insider ownership, low stock-based compensation, not diluting shareholders like crazy to pay themselves. And then the margin of safety is I want the business to have a higher earnings yield or free cash flow yield on the price that I'm paying than what bonds are today. So if bond yields are 5%, then I like to buy a business at like 6, 7 plus free cash flow or earnings yield. So if a business has all 3 of those things, then to me it's a slam dunk. And that's really where my investing comes down to now.
Nice. And do you also, I'm interested why you don't focus so much on the meaning side of things. So like the circle of competence, is that because you just like to try and broaden your horizons and learn about new stuff? Yeah,
that's actually a really good question. I do focus heavily on my circle of competence. Like I do not invest in the semiconductor industry, for example, because when I read NVIDIA's tech, I'm like, I can't understand it at all. In terms of meaning, I guess what I thought from Philtown was like the business has to resonate with you as an individual, or like, how do I say this? It has to like promote your morals. That's kind of what I was thinking.
Yep.
If the meaning is circle of competence, then yeah, I definitely focus on that too.
Right. Okay. So it's still very much the circle of competence aspect, just maybe not. It doesn't have to, be completely aligned with who you are as a human and that kind of thing.
Yeah, I've kind of thought like, if you dig deep enough on any business, you're probably going to find something immorally wrong. Like Coca-Cola, for example, is the #1 plastic polluter in the world, I believe. So it's like, it's a difficult world we live in. And I think you can kind of find dirt on anything these days.
It's an interesting topic as well to talk about the kind of morality of investing, because a lot of people that I talk to will say, how dare you invest, not that I do, but, for people that do invest in, say, oil companies, how dare you invest in an oil stock? But then I'm kind of confused because the way I see it is that when you buy shares, let's say I buy shares in ExxonMobil, I'm not giving, unless it's through a capital raise or if they were IPOing, I'm not actually giving my money to the company. I'm just giving it to an investor that holds the shares and is now selling the shares. So how do you think about that? Do you actually think it's like, we're getting to the deep topics already. Do you think like it's actually that morally wrong to invest in things like oil? I guess it kind of indirectly supports the company because as a long-term investor, you kind of take those shares out of the turnover. So it can kind of, you're holding them and not contributing to the daily volume. But yeah, I don't know. How do you see it?
Yeah, I see what you're saying where you're not funding the company, but
yeah,
I guess you're kind of benefiting from the company's success in the oil industry. And I mean, I have no problem with oil companies, to be clear. So like, I don't think that there's anything actually morally wrong with oil companies. It's just like what the world
runs where you're
on.
from.
Definitely where I'm from, Calgary, Alberta. This is like oil country Canada. So it's what our economy runs on here. But no, it is an interesting topic because I found a business the other day where it's growing ridiculous. Like revenue is growing at over 100% annually.
Wow.
But what the business does is it's a subprime lender. So they lend money to people who basically cannot get loans from banks. And the interest rate that they charge these individuals is over 100%. So that to me was just like, I simply cannot support that. And that was one of those businesses. It doesn't happen to me too often, but I was like, I know it's growing quick, but something just feels gross about that. And I don't really want to benefit from it. So it was a pass for me.
Yeah, fair enough. I guess there's the dinner party check, right? If you're happy with telling people at the dinner party what you hold, like you probably wouldn't be too hyped to say, oh yeah, I hold this great company. They're charging 100% interest rate, right? People are getting screwed, but I'm making so much money. Exactly.
So that one, I don't typically think too much about that stuff in my own investments, but that one was over the line for me.
Yeah, fair enough. And that so that's your kind of active investing approach. How do you also see a lot of investors that even follow my channel are interested in more of the passive investing approach, just the market tracking? Because and that's what I follow as well. I'm also an active investor, as you know. But a lot of the statistics aren't kind of favorable towards trying this kind of Warren Buffett, more do-it-yourself approach, even with the fund managers that try and manage money actively normally underperform the S&P. So how do you think about also passive investing? Is that something that you're still kind of doing in the background alongside your active investing? Is that something that you don't really subscribe to anymore? How do you think about it?
Yeah, so I used to own ETFs. When I first started my channel, I had a few ETFs in my portfolio, but over time, it's gotten to the point where I no longer own any ETFs at all. It's all individual stocks.
Right.
Yeah. So
big call.
I'm a super active investor, and it's partly because I genuinely love it. Like as I talk about on my own channel, I go to bed reading financial statements because I just love learning about how businesses work and like what makes certain businesses succeed and other ones fail. And
you're a rare breed.
Yeah, I'm weird, man. I'm weird, but it's what I do, and I genuinely love it. So I find genuine joy in managing my own portfolio, finding a new investment. It's like adrenaline for me when I find a new high quality business that no one else really knows about. I'm like, ooh, yes, let's get that one.
Got him.
Yeah, exactly. And I don't know. I like to turn over the rocks, as Peter Lynch would say. But I also am a huge advocate for passive investing. My fiance, for example, she could care less about following the market, reading a balance sheet, understanding the management team. What is the business's competitive advantage? So for someone like her, I'm like, just buy ETFs. Like that is going to be the best option for you statistically. So yeah, I think that there's something for everyone. And it really just comes down to the investor and what they're looking for.
Yeah, and how do you go about, I guess there's always the question around, say, diversification. If you're purely an active investor, because the way I look at active investing and passive investing is that because I'm still quite young, I don't know, like I think I do all right. And so far, my portfolio performance seems to suggest that I can kind of look at companies and pick some good ones. But I don't necessarily know that. And this might be, because I'm still quite young, it could just be that I've kind of been lucky and the market conditions have been handy. So how do you kind of factor in those risks? Do you hold quite a few companies in your portfolio to spread your risk? Is there some sort of checklist that you do to make sure that you're not kind of feeding into maybe your own, I guess like an overconfidence effect or something like that? How do you go about managing that risk?
Yeah. Well, first off, I think that's a very humble thing that you just said. And to a degree, I do the same thing myself, because over the past few years, I have been outperforming the S&P 500, but I have the same questions like, is that actually me performing well? Or is that kind of just me riding the market up? Or maybe being in an industry that just happens to be doing well over the past 3 years? Like over 10, 20 years, how am I going to perform? And unfortunately, with us being young, we just don't have those answers. But it's nice to be on track so far. But in terms of diversification, currently I have 20 stocks in my portfolio, and that's kind of the
20?
max. Yeah.
Wow.
Yeah. And that's
But I guess you're in the position where you love it, so you really can keep up with all these companies, right?
Yeah. And my diversification, well, yeah, absolutely. And my diversification is top heavy, I would say, because I believe my top 7 stocks are about 65% of my portfolio.
Okay.
And then the remaining is like kind of split into stocks that I'm not as bullish on, but like I want to position it.
Yeah.
But yeah, so I have 20 positions today. Last year I had 25 and I cut it down to 20. And what I've noticed in my own investing is as I've grown as an investor and I become more confident, I find that my portfolio, the diversification shrinks and the amount of stocks that I have in my portfolio shrinks. So I think that over time, as I continue to grow my confidence, prove that I know what I'm doing, my total positions will probably continue to go down.
And talking about being top heavy, that's kind of a good segue into how the market's looking at the moment. What's your kind of take on the whole market situation? I happen to say that the market is quite overvalued and it's obviously very top heavy. The kind of point I'm getting to is that I think now the Magnificent Seven, those stocks account for, I think, 33%-ish, maybe a little bit less over recent days, but 33%-ish of the S&P 500. Does that concern you? Like, how do you think about it, especially with interest rates being so high? Do you find any kind of value at all in these big AI companies? Is AI something that you look at? Do you think it's the future? Like, what's your take on it all?
Yeah, there's a lot to unpack there. So I guess I'll start with the S&P 500. I agree with you. I think that it is expensive today. I think there's a strong argument that it's overvalued. And I don't feel comfortable. Like, this is one reason why I don't own ETFs, is because I personally, as an individual, would not feel comfortable owning the S&P right now, just because of how top heavy it is. And Microsoft, for example, is trading for, I believe, a price to free cash flow today of 47, which is a free cash flow yield of around 2%, which is not a high yield at all. And if you take a look throughout history, the last time that Microsoft was in this price range or multiple range was literally in the dot-com bubble.
Wow.
And it's a massive company now. It's not growing nearly as quickly. So I'm just looking at these ratios today and I'm like, this is crazy. I just can't understand it. Like, I know that Microsoft is a fantastic business, incredibly high quality. But at the same time, it's like, is that actually worth a 2% free cash flow yield? Like, at what point does it stop? And if you actually take a look at Microsoft's returns over the past decade, the majority of the returns have come from multiple expansion. Like, yes, the cash flows have grown, margins have improved and everything, but the price ratios expanding is where the majority of the returns have come from. And price ratios simply cannot expand forever, or else stocks would be trading for 10,000 times cash flows today. So there is a limit. I don't know where that limit is, but eventually Microsoft is going to hit it. And when it does, future returns will be significantly lower. So what I've been saying on my channel, my speculation is that the S&P 500 ETF is probably not going to perform well over the next 5, maybe 10 years, because things are just so expensive today.
And I guess a lot of the overvaluation, particularly with the Magnificent Seven, is because it's like what you're saying. It's this multiple expansion, the idea that people are willing to pay a higher price for the same or for slowly expanding profits, but the price is going faster than what the profits are. But I guess a lot of that, if I was to play devil's advocate, a lot of the arguments from, say, Wall Street are around artificial intelligence, which is supposedly going to be the next big thing, and is, it's going to be the last thing that humanity's ever going to have to create. So what you've got is essentially these 7 companies investing so much money into, an AI future that they don't quite understand, I don't think, where they're going with it, but they're just trying to keep up with the next guy because they don't want to be left behind. So how do you view investing in AI as a theme? Do you feel like investors are being wise to pay up for, say, these 7 businesses in the hope that in the future they will bring something, or AI will be incorporated into their business which will actually increase their profits? Or do you think it's just like too early, and who even knows what the big businesses of AI are going to be?
Yeah, that's a great question. I think that AI is, I personally think it's a bit overhyped right now. Like, I go to the grocery store and I see AI-enabled toothbrushes, and I don't even know what that means. Like, what does that mean? So I think that, that's a clear indication that we're in a little bit of a hype cycle right now, which also leads to some overvaluation, in my opinion. I do think that AI is useful, though. Like, in my own business, StockUnlock, our engineers use AI to help them code, and we've seen their efficiencies double over the past 3 years.
Wow.
Yeah, so they're able to code extremely quickly now with the help of these co-pilot features. I'm not a tech guy, so maybe I just got that wrong, but
it seems like the coders are definitely benefiting from it.
Yeah, so there are definitely aspects of the business that are benefiting and things are becoming more efficient, but is it going to change the world in some massive way that these companies should be priced to infinity? I think maybe not. And that's also kind of where you get into the realm of speculation, in my opinion, because we don't really know who the winners are going to be. And I'm also kind of bearish on NVIDIA's long-term growth. Like, are we in this massive cycle where these companies are willing to spend tens of billions of dollars on chips, and then maybe in a year from now they're not, and then NVIDIA's revenue falls? Or I don't know. The semiconductor industry historically has been quite cyclical.
Yeah.
So I'm hesitant to believe that something has changed and this is going to last forever and it's worth paying, 100 times cash flows for NVIDIA. Like, it looks extremely risky and kind of speculative to me, at least.
So that idea of trying to get in and paying up for a business to hope that it catches up, that doesn't really resonate with the way that you go about your investing?
No, not really. It comes back to that margin of safety. I want a business to have an acceptable yield on the cost that I'm paying. And Microsoft, Google, NVIDIA, Tesla, these companies, in my opinion, they just don't have the yields that I find attractive on a going in price. So I've been kind of priced out of them over the past couple of years.
It's an interesting one as well, because it's kind of a bit backwards. We've seen macroeconomic conditions get harder. Like, interest rates have gone up, which naturally puts the clamps on the economy. And yet this small subset of stocks has just been like, nope, we don't care, we're running ahead. And granted, some of it's because, for example, Google doesn't have much. I think their interest expense was like $90 million last quarter, and they've got $120 billion in cash and, short-term investments on their books, which is just, Hamish told me yesterday, interest rates could be 10,000% and Google wouldn't care.
They would actually benefit because they're getting more profits, right?
But I'm interested in how do you go about investing in this higher interest rate environment? How does it affect people's portfolios? Because this is something we've not really seen at least in our investing careers, because we're quite young. I think interest rates were this high only at kind of around the turn of the century. It's been a long time. How do you think about investing during higher interest rates, and are there certain things that investors should be particularly wary of?
Yeah, so my investing, I would say, actually hasn't changed too much, because I want to find high quality businesses that can survive for literally decades. So if there are businesses where higher interest rates is going to massively affect the business, then in my opinion, that's not a very high quality business, and it's not something I'm interested in owning. So I would say my holdings do not depend on what interest rates are doing. How interest rates affect my investing, though, is my going in price. Like if interest rates are 1%, then your cash is getting essentially no return. So you want to invest it. And if I'm only getting a 1% return on my cash because interest rates are low, and then a stock maybe has a 2% yield, then that's 100% better than holding cash. So that's kind of how I view interest rates. It kind of affects my going in price that I'm willing to pay for a business, because if the business has a higher yield than cash, then I'm happy to invest my money. But on the reverse side, when interest rates are up and you can get a 5% yield on your cash, then that also offsets the price that I'm willing to pay for a business. It means that I want to get a better price for the businesses that I'm paying or that I'm buying, because the yield on cash is quite attractive. So I always want to make sure that I'm getting a better yield on the cost of my investments than what interest rates currently are.
So it affects more the valuation side of your investment approach more so than the actual businesses you look at.
Yeah, absolutely. I always focus on businesses that have strong balance sheets. And that's what I mean by businesses should not be affected too much by interest rate fluctuations.
Explain what you mean by a strong balance sheet for those that are maybe unsure or don't really understand.
Yeah, so one thing that I look for is low long-term debt. And businesses with high long-term debt, the risk can kind of be masked when interest rates are low. There's a couple of good examples. Walgreens is actually a fantastic example.
Okay.
There's a company up here in Canada called Bell. They had a lot of long-term debt, and when interest rates were essentially zero over the past decade, you didn't really see that because their interest expenses were so low. But when interest rates started rising, their debt became such a burden. And now you take a look at their profits and they've just fallen off a cliff. Like they're struggling to even remain profitable right now.
Right.
So a lot of long-term debt can be like a ticking time bomb when interest rates are rising and really affect the profitability of a company. And again, you don't really see that when interest rates have been low for so long, but when they start to rise, that's when it can become an issue. So really focusing on businesses that do not have a significant amount of debt on their balance sheets is something that I would recommend.
Right. So lower debts and watching for the interest expense.
Yes, definitely.
Yeah, interesting. I'm trying to think, is there anything else we want to cover while we're on this topic? But I think we've covered a lot of stuff on the investing realm. Do you want to talk about YouTube for a bit?
Yeah, sure. I always love talking YouTube.
How are you going with it? I mean, your channel's just you're so consistent with your content, and I love your content because you're in this value investor, or in this, I'm going to say, finfluencer space, this finance content space. But you're one of the few channels that I see actually provide really just concrete, thorough breakdowns of different businesses or financial topics, just with a no bias kind of approach, no BS approach. You're not trying to convince people to take action on this, that, or the other. You're just trying to be like, this is the digging I've done. These are the facts. Here they are in this. So I really like your content from that aspect. How are you finding it? Are you enjoying YouTube at the moment? Are you seeing growth in the channel? Like, how do you find YouTube as a business for you?
Yeah, well, thank you for the kind words. I appreciate that.
Oh, that's okay.
Yeah, I do enjoy YouTube. I thoroughly enjoy YouTube. And I think that if you're going to be a content creator or it's something that you want to pursue, you have to love making videos, because I'm sure you experienced in the beginning, you don't make any money. Like, you're pouring hours of your life into making content with no reward. And people are like, why are you doing this? You're not even getting paid. But it's for the long term, right? You got to think long term. Yeah. So I do love YouTube, and I think you got to love YouTube to stay on for as long as we have.
When did you start your channel?
I started seriously making content in winter 2019. So 5 years now.
Good time to start.
It was a great time to start in hindsight. Could not have been a better time to start. But yeah, I mean, I love it. My channel's been growing pretty consistently. So since I'm in the stock space and I analyze stocks, what I saw personally on my channel was in the hype bubble that we were in 2021 with the SPACs and speculative stocks, my channel just blew up. And my views were 70, 80,000 views per video consistently. But then as the market came down and speculation started dying down, my channel saw a hit probably mid 2022. And then I've had to kind of build it back up.
Same. I think we're probably on the same trajectory. Isn't it interesting from a psychology and kind of psychological bias perspective that views on stock market videos go up during crazy bull runs and speculative manias, and then when the market struggles a bit, interest rates are up, the market's going down. All of a sudden, people aren't really tuning into the finance content anymore. Isn't that interesting?
Yeah, it's almost like a reverse indicator. When your views are up is when you should actually be worried.
Yeah, and when the views are down, that's probably when the market's down, that's probably when people need to tune in the most. I'm interested to hear your take, because I remember when we first started, everyone kind of in the YouTube finance space was just kind of sharing their journeys, and there wasn't a huge amount of money in it at the time. Like you say, people were just kind of doing it for fun. And I think the content was really good. It was actually really interesting to tune in and hear what businesses people were running and what investments they were making and how they go about it. And I think kind of since advertisers have really clued in that the advertisers can make a lot of money from advertising on this content, naturally the amount of money that YouTubers in the finance space make has gone up. We've seen a lot of conflicts of interest. We've seen a lot of scams and, semi-scams being promoted. I'm interested, what's your take on the YouTube finance space now? Do you feel like, because I kind of get a little bit too pessimistic on it sometimes. I'm kind of like, man, this used to be so good and now it just kind of sucks. What's your kind of take on it? And do you think that there needs to be some sort of change to kind of like reverse this kind of era of conflict of interests and kind of scammy content?
I don't know what the answer is to kind of get this all to stop. I know that actually Australia has some pretty strict rules, hey? Around what you can make, hey?
Yeah, if you're a finance influencer, you need to have a financial services license, or be authorized to provide financial advice under somebody else's financial license. So we've done that, and it has stamped out a lot of the crypto bro kind of speculation, scam kind of stuff. And there has been one case of someone being taken through the courts by our financial regulator for doing that, for hosting a private community and telling their private community what stocks to buy. So the financial regulator they're okay with education. Education, the more the better, but they do not want people to start giving financial advice to people without the appropriate qualifications to do so, which I think has been fair and has stamped out a lot of the speculation. But I guess the problem is that that's just in Australia, and these platforms are global platforms. YouTube is a global platform. So it has whatever the financial regulator here in Australia says has no influence on your content or on an American person's content. So how do you think about, it's also hard with the conflicts of interest, because the more you lean into the clickbait and the outrageous content and the telling people what to do with their money and that kind of thing, the more views you tend to get. So I imagine it's quite a hard balance. How do you go about the balance of still running a successful business on YouTube, but not veering off into the conflicts of interest?
So what I try to do on my channel is I do accept sponsorships, but one thing, you have to make it known that your video is sponsored if you're going to accept one. I have seen a lot of channels where they don't actually disclose that, which is not good. So always make sure that I'm disclosing if I'm sponsored. And I try to only accept sponsorships from companies that I have researched. And when I'm talking about companies, I don't accept sponsors from stocks or public businesses to go and talk about their business. That's something I just don't do. When I talk about sponsors, it's brokerages up in Canada that are trying to come up or take some market share from the large banks. And it's they have a cool app. They seem to respect their investors on there. And so those are the types of sponsorships that I take, is from reputable companies that I've researched and I think actually provide a good service. That's kind of how I look at it, is would I actually use this product? Do I think that it's actually a good product? And is it something that I'm comfortable to share with my audience?
It's a hard one though, especially with, I don't know if you, being over that side of the pond, have gotten these kind of outrageous deals. And we can even talk about some of the finance creators being caught out for promoting, say, FTX, and we don't have to go into the specifics of it. But when I think it can be very, very difficult. One of the problems is that some of these companies are willing to sink so much money into sponsorships of these channels that it can be quite hard to say no to that. There's the classic saying, everyone's got a price, and you like to think that no, I'd never do that. But I think it's quite challenging. So I think having a kind of good set of rigid rules around when you do and don't accept sponsorships, like what you seem to have, is a really smart strategy.
Yeah, I get approached by companies on a weekly basis, if not on more frequently, to try and promote their stocks. Like there'll be small companies that just IPO'd and they want some exposure around what their business is doing to try and increase liquidity so they can raise more money.
Wow.
And like technically there's nothing illegal about me doing that. It's just like morally, it's not what I want to do. And they're willing to pay well into the 5 figures. Sometimes, like I got one offer for 6 figures once and I was just like, no.
Wow.
It's just not what I want to do, because as Warren Buffett says, you have to think about the reputational aspect of the decisions that you make. And you want to prioritize protecting your reputation, because that's really what matters over the long term. If you screw up your reputation, then like you have nothing. So I try to focus also on like, if I did accept one of those kind of maybe low quality sponsors or promoted a stock, like how would that affect my reputation and how people really view Daniel Pronk's opinion on YouTube?
That's a really good way to think about it.
Yeah, because you can accept like a $50,000 sponsor today for kind of a sketchy deal, but if that's going to harm your brand or your image over the long term, then it's actually not going to be worth it. Like it may affect your ability to make money in the future. So then it's actually like, I view it as kind of taking a short-term profit versus a long-term profit. That's also morally better in my opinion.
That's a good way of thinking about it, especially because from your perspective, if you're making these really well put together kind of breakdowns of particular companies that you have looked into in a non-biased way, and obviously that company hasn't approached you, you're just making it of your own accord, and then all of a sudden they see, oh, this micro cap gold miner in Australia, then you're right. And let's be real, probably the reason that those companies reach out is because they know that they're not a good enough company to naturally attract, interest from investors and analysts. So they're almost trying to buy their way to a better market cap in a way. So, but then people would just, they would just see that content and all of a sudden, this gold miner goes bankrupt. Oh, hang on, didn't Daniel talk about that? And then all of a sudden, you're right, your reputation's kind of blown up in your face.
Yeah, exactly. And then no one wants to watch your content anymore. Like, it's just like diluting your content with crap content, and it's not what I want to do.
I'm interested, do you think this problem's going to get worse though? Because I don't know if you found the same, but what I've found is particularly with the pullback, higher interest rates, with businesses that like to advertise on YouTube, their marketing budgets have shrunk quite substantially. So because YouTube is a bidding system, so we make money from the ads that are displayed in our videos, but the advertisers bid each other up on those ads. So obviously when their marketing budgets are lower, there's less bidding. And what that translates to is that investing or finance YouTubers are making less money per 1,000 views is the metric that gets tracked. So do you feel like that slowdown could actually even make these conflicts of interest and these scammy kind of sponsorship deals more common as some YouTubers try to kind of make up for the difference?
Yeah, potentially. But the FTX example that you brought up, that kind of happened when interest rates were low and it seemed like companies had infinite money to spend. So I think that it was almost more enticing because they had essentially more leverage over the influencers. Like I know that FTX was offering a ridiculous amount of money to the finance influencers, and that's why a lot of people signed up with them, right?
You're probably right in that sense, because they would have more money at the time to really just go for it. So I think the underlying problem just seems to be greed, like as is always as is always the case. It seems like the underlying problem is greed. Yeah,
I wouldn't mind some more regulation to come long term, and I do think that long term there will be more regulation. Like the Roaring Kitty stuff that was happening was just crazy, man. Like I don't know if the SEC is going to look at that and be like, yeah, we like this, we're going to allow that to continue happening forever,
It's so funny when he was on the recent live stream and it was like, no, I'm not going to say this until the stock is not halted or something like that. It's like, man, what are you doing? Like, he's like, no, I need the stock to be trading before I say what I'm going to say. Just give me 1 second. It's like, at what point does that get into market manipulation? That's a good question.
Yeah, exactly. I mean, maybe it comes down to intent, but I have no idea.
All right, well, let's switch the focus because since we last spoke, you have started another business called StockUnlock. Do you want to, if for people unfamiliar, do you want to give, what's your quick 30-second explainer on what StockUnlock is? I'm sure you've had to say this a lot of times at this point.
Yeah, a few times. Yeah, so StockUnlock is a stock analysis and portfolio tracking platform. So it allows you to do in-depth research on the fundamentals of businesses. And kind of like what our moat is, because I love moats and whatnot, is we grade and score the fundamentals of any stock on the market from 1 to 5. So if the stock has a higher score, then it typically has a much better balance sheet, it's growing, has a better management team. And our users have told us they love this feature because you can avoid really bad stocks and find much higher quality stocks in literally 10 seconds. You can even screen. We have a screener that filters out the highest rated stocks and the worst rated stocks.
All right. That's super interesting.
But yeah, it's not a buy or sell recommendation. We make that very clear. Just because it has a high score does not mean it's a good buy. It just means that it has the things that investors typically look for, like a lot of cash, little debt, revenue's growing, management team owns a lot of stock, there's low stock-based compensation. The elements that make a good investment are what's graded. But again, it doesn't mean it's selling for a good price today.
I like that. I think a lot of those analysis sites push it too far and say, look, these are the best stocks you can buy based on our screener. And of course, you're right in that, it's a great company, but it might not be a good investment. So I think that's really, really awesome. But it's an interesting story because we see a lot of YouTubers try and do these side projects or start their own businesses. And I don't know, some of the businesses aren't too flash, or they're a little bit scammy, or they try and, kind of squeeze their subscribers for as much money as possible. But what I like is that I was saying to Daniel off air before, I like this because this is actually an example of you making YouTube videos and then going away and actually building just a great business on the side as a YouTuber, which is really good. How did you start it? What was the process? Tell me about the actual process of building this business.
Yeah, so there's a long version of how our company started, but I'll try and condense it. So I make YouTube videos. I'm sure we all know that by now. So I was making YouTube videos back in 2021, analyzing businesses, and I would put the company's financials in spreadsheets, on my own, manually typing in these spreadsheets. One of my viewers from New York happens to be a software engineer, and he starts emailing me relentlessly. And he's like, I'm building a product and a platform that is going to save you so much time. It's going to just do all of the work for you. It's going to show you if a company has a good current ratio above 2, strong balance sheet. And basically this guy was building the product that I needed for my channel on his own for 5 months before I finally got back to him. So yeah, and then him and I hopped on a call. We had a beer together on the call, ended up talking for 2.5 hours, really vibed. And then we just decided let's continue working on this. I officially came in and I started collaborating with him. And then that went on for probably a few months. He ended up leaving his job. He was a very well-paid software engineer in New York, but he was like, I have savings, I got money, I have investments, I want to build this company. So we officially started the company, named it, got it incorporated in Delaware, and we really just launched it to my YouTube community. And initially it was free in the beta, and then we started charging for it because you need a sustainable business. We were buying data and whatnot. And we've just been working on that consistently for the past 3 years. I guess I should say that in 2022 we got reached out to by Y Combinator, which is one of the best accelerators in the world for startups. And yeah, they invested in our business. So Y Combinator owns a part of our business. We ended up raising 1.5 million in 2022 to really fund the growth of the company. So we have 6 employees now, and it's growing every month. It's doing well. We could be profitable tomorrow if we wanted to, but we spend money at a reasonable burn rate to grow the business essentially. So we've just been kind of grinding it out.
Dude, that's such a good story. Tell me about the process of raising money as a small business with Y Combinator, because that's something I know businesses do it, but I know nothing about that. I have absolutely no clue how that works. So, and you just said before that Y Combinator reached out to you.
Yeah, so they reached out to my co-founder, And it's not normal for Y Combinator to reach out to businesses. Like, I actually didn't even know what Y Combinator was at this point. So they told us like, hey, our application deadline was like a week ago, but we're interested in your guys' business. Like, we'll extend it and you guys can apply. So we were like, okay, cool. So we applied. We got an interview. And then after the interview, I think we got a second interview, and then they accepted us into their accelerator program. And then you go through Y Combinator for about 3 months, and you're working with very intelligent people, like people who have created startups or worked at startups and just like absolutely killed it, sold their businesses, made it, like they're done.
Is there money involved at this point or not yet?
Yeah. So at that point, I believe, I don't know the exact number that they gave us, but they invested 7%. I think they gave us like $150,000 or $200,000. And then we went through the accelerator program for 3 months. They like mentor you every single week, and that you have weekly meetings with them. And then at the end of the 3 months, it's like their accelerator startup school. And then at the end, you go out and you try and raise more money. And they share their entire investor network with you. And so that's what we did. And then for about 2.5 months, we were consistently raising money. And we closed our investment round at 1.5 million. And it took about 2.5 months. I wasn't the one actually pitching the business. That was my co-founder. And he did a fantastic job. Like, that guy's a stud. So I can't actually speak to like what those conversations were like, because I wasn't always part of them, but it seemed intense. He was like 12 hours a day having meetings all the time, like reaching out to people, trying to play this game of like getting investor capital, making them excited, trying to get them to see the vision. And it seemed intense.
So now you've raised $1.5 million, which is amazing. And now you've got investors, I guess, that you have to work alongside or work with. How do you go about it? So now you're in it. We were on the outside, where we're the investor looking into these companies and deciding whether we want to invest it. Now you're on the other side as well, which is kind of interesting. So you were talking about kind of the cash flow management before, how you could be profitable. Obviously, you choose not to be because you're growing, but you're not spending money egregiously or in a silly way, which is obviously, I'm sure the investors are happy to see that. How do you go with your co-founder, though, now having to talk to investors, and how does that work? Because you guys probably want to build the business in a particular direction. Investors get a say as well. How does all that schmoozing and kind of keeping everyone happy actually happen in real life for a small business? Yeah,
so we're actually very blessed with our investors. We send out a monthly update with all the key metrics, like what's revenue, how much did it grow month over month, year over year, what is our subscriber count, cash in the bank, burn rate, all that, like the stuff investors want to know. Yeah. So we send that out on the first of every month. And then beyond that, we really don't hear from our investors. That may be a good thing, because maybe they're like, okay, these guys are doing well, like they're going in the right direction. But the only time that we really hear from our investors is when we ask them questions like, hey, do you guys have a contact who would be in this industry, or maybe like an analyst team that would want to take a look at our product, give us some feedback? Then they'll respond. But other than that, they kind of just let us run the business, which is actually awesome. So it's worked out well for us.
And how do you guys go as founders, like paying yourselves out of that pool of money? Like, is that something that you kind of still important to you to make sure that you are paid well for your time? Or is that something that you kind of think, the benefit will be in the long term for us, so let's forego it? How does that kind of work?
Yeah. So when we first started, we had no salary. And then when we raised that initial like 200,000, we went to a $30,000 a year salary. So
woo,
making big bucks. And then as we raised more money, like after we raised money, I think we went up to 70,000 each. And then now that the business has grown, we've kind of scaled our salaries up with the business.
Right.
But we're still not making like crazy money.
I think it's important to do that, though, because it probably it enables you. It enables your brain to kind of be like, no, I can focus on this business now, because that's kind of like, if I scale my pay with the growth of the business, then it makes sense that I should, really put instead of making maybe the next YouTube video or doing something like that and watching the AdSense revenue, it's like, okay, I should be putting my time towards this business because that's where my return will be. So I think there's a strong argument. Like some people argue, no, just take no salary, I'll be rewarded in the long run. But I think it's a good idea to still pay yourself and have it attached to the success, so that it's like that intrinsic motivator or that financial motivator to drive you to work harder on it as well.
Yeah, the way that we were mentored by Y Combinator, they told us that we should take a salary where we're not stressed about money. Like if we're stressed about money, we should be paying ourselves more. So we kind of decided on salaries where we can live comfortably and like still invest money, still build our assets and whatnot. But it's not like crazy. Like we're not like multimillionaires or anything like that. I also was listening to another founder talk about his business, and he was making the argument that if the founders are actually paid well by their company, then they're not as motivated to sell out at some low valuation. So like if you get an offer from the business and you're not paying yourself a salary and you're very stressed about capital, then you may accept a pretty bad deal. You may get acquired for like a low price and because you just want that payout. But if you're actually paying yourself well and you're not stressed about money, then it helps you focus on the long term and not just take like the first offer that comes through the door. So that's kind of how we viewed it too.
Yeah, interesting. And so now what's your focus going forward? Because you're making YouTube content still very regularly, I see, and you've also got this business which you're working on with your co-founder. How's your time split? What's your focus at the moment?
Yeah, my focus is very much so on the business now, on StockUnlock. It's kind of shifted as that business has grown. I just try to think about where's the highest return on my time. And again, as that business has grown, my returns have become better and better over there. But my YouTube channel is the number one way that we grow. It's you know, I use the platform in every single video. It's how I analyze stocks. It's actually the platform that I use to track my portfolios and whatnot now. So it's just like I have an audience of roughly 250,000 people that see the platform every single day, right?
Yeah,
so
that's good.
It works really well, and I do believe it's a great product, so I'm happy to use it.
Yeah. I'd hope so. I'd be a little concerned if you're like, this, you know, it's all right. Like, could be better.
It could be better. It's getting better every day, but it's still at a great spot.
There you go. And how do you just talking about more life in general, how do you maintain, because you could work as many hours, like the more hours you work, the better, essentially, growing this business. How do you've got YouTube videos to make, you've got a business to run with your co-founder, you've got your personal life as well. How do you kind of structure your life and your day to make sure that you don't get burnt out? Is that something that you've struggled with in the past at any point, like getting burnt out because you've been working too much or you're losing passion? How do you manage your time so that you are still, because you look like you're super psyched about everything, like you're hyped up about this stuff. How do you manage that?
Yeah, I mean, I think passion definitely helps. Like I've found what I love doing, and I think that it helps with not getting burnt out when you actually truly love what you're doing. But with that said, there has been times in the past where I've burnt out because, to your point, when you're an entrepreneur, if you simply put in more hours of work, you're going to make more money. That's just how it works. You you set how much money you want to make by the amount that you work. And when I was single and in my earlier 20s, I would just work like 12, 14 hours a day, just all day, because I wanted to. I know you know Nate O'Brien, and in one of his videos, he said he front loaded his work. Yeah. So he worked extremely hard in his early 20s, and now the guy's basically retired at 25. I didn't go that extreme.
So crazy.
I know, right? It's so crazy. That guy is such a stud. But that's kind of what I did too. In my early 20s, I really set myself up to. Now I'm 29 and I don't have to work as hard. Like I have a really good nest egg built where I just simply don't need to work as hard anymore. And I can actually take that time to focus on my personal life, my fiance, traveling and whatnot. So I'm pretty blessed and I'm happy where I am.
Yeah, nice. Where do you see yourself in 5 years? What's the plan going forward? StockUnlock's going to be this massive thing. Do you guys hope to just grow it to infinity yourselves, or have you had discussions with your co-founder about, you know, what happens if we get this mad offer to be acquired by someone else? Like where do you see the future of YouTube and also your business StockUnlock?
Yeah, so for YouTube, I think I'm always going to make content because, as I said, I'm someone who I just love investing. So I enjoy YouTube. Like I genuinely love making YouTube videos. So I think I'm going to do that forever. I don't know if I'll maintain the consistency that I have today forever, but I see myself making content for the long term. In terms of StockUnlock, we've had this conversation a lot, and we think like investors. So if we got some insane price for the business tomorrow that was just ridiculous, we would probably take it. But it would have to be pretty insane. So for the moment, the plan is just like continue building the company, continue focusing on all the right metrics, just continuing to grow, build more features, for our users, work with our users. And so that's the plan right now. We're not planning on selling the company, but again, if someone offered us 100 million tomorrow, we'd probably sell.
Then you go off, float away on an island somewhere.
Yeah, then I'd be one of those guys from Y Combinator, like, I'm done, I made it. Go hang out with Sam O'Brien.
Yep, and so the speaking career begins.
Exactly.
That's the end game. That's the end game.
Yeah, it all just depends. We'll see what happens.
No, that's super interesting. Oh, thanks for taking the time to chat, Daniel. That's a great story. Appreciate your insights on investing and also on growing a business. It's really refreshing to see. It's refreshing to see a content creator make a business where the business is not about squeezing as much money out of their fans as possible, where it's actually about providing a product or service that actually benefits other people. So I think you're doing a great job, man. Big ups from me. And I'm happy for you, man. It seems like your life's in a good spot and your investing's going well and everything's going well. So thanks for taking the time to have a chat, dude. Where do people find you? Obviously on YouTube, at Daniel Pronk. Where else? Do you post in other places as well? Yeah,
I post once in a while on Twitter. So Daniel Pronk on Twitter. And then obviously if people want to check out StockUnlock, the platform that I built, would really appreciate people checking that out too. It's a great platform. So check it out. It's great for fundamental investing.
Yeah, awesome, dude. Well, thanks very much for coming on. Really appreciate you taking the time, and I'm sure we'll talk to you soon.
Absolutely. Thanks for having me on. Appreciate it.